Risk number two is oversupply. I keep hearing people talk about oversupply in the housing market. Now, of course, that's juxtaposed with the fact that we're in a housing shortage right now and housing crisis, and we just simply haven't built enough. But leave it to developers. If there is blood in the water, they will build eventually. And just as we've seen in headlines and research reports, the industry throughout the United States could build, in this article, 400,000. I've also seen reports up to 500,000 new apartment rentals being delivered in 2022. But one key point to note on that fact is in the third paragraph in this article is, the Sun Belt. Certain markets, all markets aren't created equal, and the Sun Belt is poised to account for 25% of all the new units, with Dallas, Phoenix, Austin, Houston, Nashville, and Atlanta, and I think Huntsville should be added to this as well, really leading the way, really just seeing an incredible amount of new supply coming into those markets. I will add that there's a lot of demand in those markets as well, in migration, but those are the markets that you could see in that imbalance shift to all of a sudden seeing too much building, because every developer and every investor are crowding into some of these Sunbelt markets, which we see as a potential risk factor. Looking at just starts and permits for multifamily housing, you see we definitely are, at a very nice peak in terms of starts and housing, but for starts and permits. But what I find interesting is we're really just on the same trajectory and trend. If you look at this trend line, the pre-2014 trend line, we're really on pace and slightly below that pre-2015 trend line. In post-2015, it really kind of leveled off. And this has really led to us just not building enough housing, which has caused some of this housing crisis we find ourselves in. Just some quick statistics. 45% in multifamily housing starts just in 2021. Permits, 55% have increased. Existing home inventory, it's 1.6 months of inventory, and there's a 5.8 million house gap for single family homes compared to household formation. We can have all the plans and permits we want, but there's still construction backlogs. This is a construction backlog indicator from, I believe, this month. And you can see from January 22. We still have an 8-month backlog for construction. So that's pretty significant. And just looking at this chart, we just haven't built enough housing, and it just dropped off after really 2007, 2008, and we just have never recovered. We just never have. And at the same time, we've seen an incredible amount of household growth over the last several years. And this is just looking now at single family home prices, single family home supply. Again, millennials are at an age where they would like to buy a home, but there are no homes to purchase, and they are too expensive for most. Even if they could afford the monthly payment, coming up with the $50,000 to $100,000 down payment, even as saving rates are at all-time high, and the consumer is in a historically incredible position, most just don't have that type of savings. And many are also coming to the realization that they're not viewing their home as an asset, more as a liability, and maybe the best investment for their largest chunk of their net worth may not always correlate with where they would like to live. This is just some of the markets with the highest amount of construction as a percentage of inventory. Again, I mentioned Huntsville earlier, and Nashville are two high flyers that I would want to pay attention to. Both have great demand fundamentals. But you can have great demand, but you can still build too much housing. One way to mitigate it, which we'll get to in a second, is finding markets that have really solid growth, but aren't seeing the oversupply. And that would be like a market like Indianapolis, where it has incredible amount of demand, incredible amount of absorption, but incredible amount of rent growth and population growth, but we're just not seeing all of the supply coming in. And partially it's because many of these Sunbelt metros are just, they're in the limelight, and they are gaining so much investor interest and interest from developers. So again, we're going to look to mitigate and adapt. We're going to look for balanced markets We also want to diversify. We don't want to have all our eggs in one basket. So we want to be in several markets. And then in those markets themselves, we want to be very sub-market specific, neighborhood specific, to look at where the lack of supply is, but it is still growing. And that's what gets us really excited. I'm going to speak about it a little bit later on one of our fund assets. Just so much demand, just no supply.